welcome to the September version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. If you have any questions during our presentation today, please write them in the chat and I will ask them to Chris if they are timely. Otherwise, we will get back to you directly or address it in our next MSOM. This month's edition is titled A Cut Above, where Chris will walk us through the latest on the Fed's bold move this afternoon, the markets, and the endowment bias. Take it away, Chris.
Thanks, Adam. The Fed surprised some this afternoon with a 50 basis point cut, kind of the last major central bank to the party. Albeit outside of Japan, who's actually just begun rate hiking regime, which we covered last month in the yen carry trade fiasco that we saw a bit of volatility surrounding following the sell-off in mid-July into early August. Since then, markets have candidly recovered back nearing all-time highs, with our own TSX composite index leading the way, up 8% quarter to date since the start of July. Meanwhile, the tech-heavy NASDAQ has not done as much of the heavy lifting as months past, with it being flat to slightly down so far this quarter. A big reason for that has been the makeup of our index. Obviously, the United States is extremely focused on technology heavyweights, the FANGmans, Facebook, Amazon, Netflix, Google, etc. Can't forget NVIDIA. Versus here in Canada, three sectors, the financials, materials, and energy, make up about 60% of our overall index. In that energy cohort, two of the large players would be Enbridge and TransCanada, which are closer to utilities than they are energy producers. All of those industries have a significant amount of leverage in their business models, meaning debt. So when the price of debt goes down, that being in bond yields in both the long and short end of the curve, that's a positive tailwind for our companies here in Canada. And we've seen that particularly in our Canadian dividend mandate, with our real estate holdings as well as our energy stocks producing strong results in August and so far to date here in September. Meanwhile, we've seen that volatility remain in the United States and continuing here today. Interestingly enough, a lot of that comes from the fact that our economy may not be quite as strong as our neighbors south of the border. That allowed inflation to cool a little bit quicker here, unemployment to tick higher to the highest level since May of 2017, excluding the COVID kind of blip. That allowed the Bank of Canada to already make multiple rate cuts so far to date, driving down bond yields and providing that positive tailwind for our stock market here in Canada. Our inflation CPI has moved down to 2.0% in August, down from 2.5% in July, right at the bottom of that 2 to 3% range that our central bank targets. That's all positive, and we continue to see that weakness or fluttering of our economy to allow the Bank of Canada to continue driving rates lower. It does appear like this is just the start for the Federal Reserve in the United States, and that many more rate cuts are here to come. We think that that could be a bit aggressive and potentially actually cause a bit of an issue in 2026 or even late in 2025, as inflation could come back up if they ease too far too quick. That has been highlighted. The Fed targets a 2% inflation target. I think they move closer to that in the month of August. And initial jobless claims for the week that ended September 7th is among the highest in the past 2 years. But all of that said, even Mrs. Somm, who invented the Somm rule that we talked about last month, in that a 50 basis point rise in 3-month unemployment has signaled a recession 100% of the time, going back to, I think, 1970 or so. Doesn't think we're in a recession this time around, because of the fact that the labor market is still pretty strong. Unemployment remains low, near much lower than normal spikes, and although it's moving higher and that trend is upward, we're not too concerned about the US economy at this point. I believe that the actual risk is in the Fed going too far, too quick with their rate cuts because they want to avoid a recession, which brings inflation back. A big problem is the base effect. That means if you think back to October of 2023, oil was closer to $90. Today it's hovering around 70. So just that overall year-over-year comparison, which a lot of people focus on, has a base effect that is being driven through the price of many things. Oil is just not the only component. We need to transport goods. A lot of the goods that we consume are petroleum based. There's many aspects to that that come through the inflation data. And so that is something that we are concerned about and watching very closely and position our portfolios accordingly. With that said, the US continues to have extremely high valuations. Equities are priced at a discount relative to earnings in other parts around the world. We are getting more bullish on names that have global exposure. Some of them rely in the United States, but we've also added a global opportunity small cap fund following a rate cutting regime. Small caps tend to outperform large caps, and so this could be the start of a rally there. We also see relative value in other countries, Canada being one of them. We just added to our Canadian exposure overall in most of our client portfolios, but also are very bullish on developed economies around the world outside of North America. One of the issues that we have seen is the Chinese economy. The Chinese economy is growing at 5%. That's lowest since, again, the COVID crisis, as well as the devastating massacre in 1989 of June in China. That was the only other time that economy was growing at only 5%. For an emerging market economy, you would expect higher growth there. The Chinese economy now produces more vehicles every month than the United States or Europe, and they consume more gasoline every month than the United States and Europe. That's weighing on the price of oil. That coupled with a bit of a buildup in OPEC potential supply that could come online at a whim's notice has put a bit of an overhang on the industry overall. The stocks, albeit, have held up relatively well. Because of this, we took a little bit of profits, trimming our overweight in the oil space and redeploying that into other areas of the market that we see more value. One of those is the gold sector. We've talked about this for a couple of months. It's been playing out quite nicely since we added the Dynamic Precious Metals Fund back in June and then re-upped in August when basically everything was getting washed out. Gold's now at an all-time high, near $2,600 an ounce USD. So basically $1 million Canadian dollars. That's up 50% from the 2022 lows and a nice run even since February. There's several aspects driving this. One would be that a weaker US dollar allows more foreign buyers to buy up gold. Central banks around the world, including China, which is leading the way, are favoring buying gold over US treasuries. And then the geopolitical uncertainty in Russia and the Middle East provides a wild card that people like to flight to safety with gold. And then lastly, it's a zero yielding asset class. So if the interest rate you're getting on treasury bonds comes down, the opportunity cost of holding gold to holding treasuries narrows, which a lot of investors like. So there's many bright signs for this. And then the chart on the bottom right is showing you the inflation adjusted price for gold, which is nearing those 2011 highs and almost all the way back to the 1981 peak. So that is a beneficiary for the gold producers. And like we mentioned before, we're leaning more into the producing companies versus the commodity itself. The endowment effect. Back to our series on behavioral finance. I have a kind of all-encompassing part coming out in a few weeks that kind of recaps all of these very cool kind of quirks that we see, these biases and heuristics in finance that allow us to understand how we make decisions in making investments and how to avoid our mistakes and possibly benefit from the repeated mistakes of others that succumb to these biases. So what is the endowment effect? It's basically the tendency to overvalue something simply because you own it. I've been dealing this with clients since I've started my career. People have an anchor to where they purchased a stock, where you should be asking yourself every day, would I buy it at this price? There's tax consequences to consider, but to be honest, the lower the stock goes, the better the tax consequences come in your favor for getting out of that position. A lot of people get that endowment from owning something. It becomes like an asset to them versus basically that thing that could be sold and reevaluated every day. There's a landmark experimental test of the endowment effect by Daniel Kahneman, the godfather of behavioral finance, and Richard Thaler, where they asked two groups to value an identical mug. Astonishingly, the owners of the mug had more than double the price compared to other buyers. So what they did was essentially gave the mug to half the participants and then asked the other half the participants what they would pay for that mug. And it seemed to be roughly double just because those people owned it. I'm sure many of you have feel this as well. I could use another example with our Swifties, those Taylor Swift fans out there, many of them who may have got lucky in the auction to get a ticket at retail at cost for, let's say, $200 or $300, purchase those tickets, and at this point now may be able to resell those for upwards of $1,000, if not more, and are refusing to sell. But if you ask them if they would purchase that same ticket if they did not own it for $1,000, they would not. And so hopefully that example could show you how the same person has a different value for something they own, whether something net new that they need to buy. And when you apply these type of principles to your investing and think in a rational way versus in an emotional way, there are opportunities for professional money managers to seek out arbitrage or alpha in the market to help generate returns for our clients.